Hello there, welcome to another live webinar with us from Group Nova. My name is Sri and I'm your facilitator of the day. And what are we talking about today? We are talking about utilizing option strategies to enhance your trading. And in the studio, we have our very good friend David Ng, the proprietary trader from IcebergX Sdn Bhd. And he will share the basics of options trading and how to utilize various strategies for options trading. David will also touch on key factors affecting options prices and how you can calculate your profit and loss for option strategy according to the strategy you choose. Gain a better understanding of options, tune into this webinar and find out how you can add options to your strategy. Key points that David will be covering: introduction to basics on options trading, and some relevant concepts, how to calculate the profit and loss dynamics of the option strategy, discovering various option strategies to minimize your risk, and understanding various factors that affect options pricing. David, as I shared earlier, is a full-time proprietary trader with IcebergX Sdn Bhd, a local proprietary trading firm based in Kuala Lumpur. He's done extensive research and is well versed in the commodities and indices markets. He currently trades the Malaysia Index and crude palm oil futures. Previously, he led a dynamic team to market futures and derivative instruments in the Malaysian market with a prominent local broker. David has experience speaking about the futures market in trade events, and in addition, he has provided frequent commentaries to local media like The Star, Business Times, and The Age in that role. David, if you're all set to go, I'm going to give you sharing rights very shortly. But before we kick off, I'm just going to do a very short poll. Can you hear me loud and clear? Please respond via the poll if you can hear me loud and clear. All right, great. Majority of you can hear me. For those of you who can't, just you might want to try re-plugging your headset, and that's what I'll probably let you know via the comments as well. Okay, so David, you're all set to go. Let me just close the poll and hand the reins over to you, David, please.
Hi, Sri. Just a quick sound check. Can you hear me?
Yes, I can hear you loud and clear.
Are you able to see my slides as well?
Yes, I can.
Okay, that's great. Firstly, just thank you, Sri, for the kind introduction. And thank you, Phillip, Noah, and as well as CME to organize this webinar today, talking about using options as a way to navigate your trading journey. So if you've been trading a futures market, I think options will be a very good additional to your trading arsenal. Keep in mind, I think options itself, it does provide a lot of opportunities, but if you use it wisely, so in other words, you really need the kind of a lot of knowledge beforehand prior to engage into options trading. So with that, I'm just going to go to a usual disclaimer. So any view that's presented here today is purely based on my personal view. It doesn't reflect any opinion by Phillip, Noah, or in fact by the exchange itself. As I mentioned earlier, I think dealing with futures or even in fact in options market does involve a lot of risk. So make sure you do engage with a licensed professional before you actually make your trading journey. So with that, let's just get started with what we're going to cover today. So I think firstly in today's session, we're just going to cover some of the basic concepts on trading options. I know to those who are new to options market, it gets quite intimidating, especially with some of the key terminologies that we used to hear when it comes to options trading. I hope I can debunk those myths, and I hope I can give you a clearer concept on how to trade options. And with that, I think because given my background trading the futures market for a pretty amount of time, I think options itself, it gives an added advantage in the sense that it gives you more flexibility. But keep in mind, there's also certain drawbacks that it comes with options trading. And I do hope that, if you get yourself engaged in the options market, make sure you're well educated beforehand. So I'm just going to give you some simple concepts on or rather simple illustration on how to calculate the profit and loss, especially some of the key strategies of using options strategy. And obviously, I think options is highly flexible instrument in a sense that it gives you a lot of variety and versatility when it comes to designing certain strategies that's able to cater on certain conditions of the market. Now, obviously, with other instruments like perhaps like futures market is a very direct approach. Options, on the other hand, gives you a more dynamic approach in a sense. It gives you a bit more versatility. So when it comes to different market conditions, despite futures is always thrive in a very trendy markets, but options is able to generate the kind of income whenever the markets are still pretty much on a sideway or there's no trend in the market. So that's the benefit of using options as a way to, despite any of the market circumstances, options are able to generate that kind of income regardless of the market directions. And obviously, I think there is, if you just Google it, options trading, there is a lot of, I would say, theoretical models. The famous one will be binomial model that actually try to, calculate basically the price of the option. So I don't go too detailed in those models, but what is important is that we need to understand what are the factors that actually can affect your option pricing, because with that, we are able to understand better on what are the factors or key factors that actually influence option pricing. By that, if you are holding a particular option, you should be more aware that certain factors does affect the option pricing. So we try to in certain ways we try our best to mitigate those factors, and in other words, we try to minimize the risk of our options, having a less fluctuation in terms of prices. So let's get into the basic. What's an option? I think option is the right but not the obligation. Obligation to either buy or sell a particular instrument. But especially in this case, the underlying asset. If you just look at the CME options we are talking about, is basically on the micro E-mini Nasdaq and the micro E-mini S&P 500. So these are only two available options that's available on the market for you to trade. So the particular underlying asset that we're referring to today, if you're talking about options, is basically this micro E-mini futures on the S&P 500 as well as a micro E-mini Nasdaq market. So particular underlying asset at a fixed price, and basically it gives you the right whether you can exercise the option before its expiry or on the expiry date itself. So basically, is in short form, options is just a financial instrument that it derives its value from its underlying, and is able to trade on the market. And in other words, I think the key thing is that if you are buying a call or a put, or if you're a buyer for a particular option, it gives you the right but not the obligation. Now, if you reverse that role, if you are selling a particular option, there's no right for you if you're a seller. There's more to obligation. So whenever a buyer of a put and call, if he buys from someone as a seller, the seller has an obligation whenever the buyer for a particular option exercises his rights. So this is an important distinction. So in common options terminology or options trading, if you are really be a seller of a particular option, whether it's call or put, you're actually subjecting to yourself to massive risk. Why is that so? Because if you are being exercised for a particular rights, you have to waive or fulfill those obligations. So I think in that sense, your risk of loss is actually pretty much unlimited. Now, on the other hand, if you are a buyer of a put or a call, you are actually try to minimize your risk or your exposure to the amount that you're willing to pay upfront for a particular price of the underlying. So in that sense, you're well protected. If for whatever instances the market go against you, you always be suffering just only the premium that you pay for a particular put or call. Unlike if you're a seller, you are actually subjecting yourself to more risk, and in other words, it's unlimited risk. So in common notion, I think there's two types of options as well. One is called call options. So call options basically denotes that it's a contract that gives the buyer of the option the right, but not the obligation to purchase a particular underlying asset. So in this sense, if you are, so normally in a classic example, if you are having a view of the market that the market is going to go higher in a foreseeable future. So what in these instances, a lot of people are just going to the market to buy a call option. So if you're just buying a call, let's say a call or micro E-mini Nasdaq at a particular strike price, So when you are foreseeing that the market, the micro E-mini Nasdaq market is going to go higher. So when the market does in fact go higher, those call buyers entitled to actually exercise a particular contract, because there's more incentive for you to exercise that particular contract. So in that sense, call options usually refers to the buyer of the option whenever we have a view of the market that's going to go higher. So it gives the right of the option, the holder of the option, to purchase or to purchase a contract at a particular strike price that's been predetermined at a set date. So that's pretty much how a call option works. Now, put option on the other hand works differently. It gives the buyer of the option the right to sell a particular asset or a particular underlying at a fixed price at a predetermined set price at a predetermined set date as well. So call example is very simple. Is if you believe the market is going higher, you engage in a call contract. If you have a view that the market is going to go lower in the foreseeable future, then you engage yourself in a put option. Now, put option, in other words, is a very good instrument for you to hedge against your portfolio. So, example, if you are holding a particular futures contract or basket or portfolio, and you want to make sure that you want to protect yourself against any inverse movement in your portfolio value, you can always purchase a put option. You just pay the premium for it. So in case the value of the portfolio does decrease because of market condition, so you can actually exercise a put option. So in a way, you're buying an insurance against your portfolio value or your basket of your portfolio. So in a sense, put options does give you the kind of a minimal risk. It does minimize your risk overall by giving you an option to hedge against a basket of stocks or a basket of portfolio that you have. So there's two types of option expiry. One, we have the American option. American options can be usually exercised anytime before or on the expiry days itself. So it gives you a flexibility. So if you are, if you are trading on the micro E-mini options, do take note that every quarterly options, your March, your June, your September contracts are usually expired with American style. That means you can obviously, if you hold those kind of contracts, you can exercise anytime. You don't have to be subject to you only can exercise the expiry on the expired date. So that gives you a bit more flexibility. Now, if you look at a series of option series on the CME micro E-mini options, you notice there's also weekly and also monthly options. Now, for weekly and monthly options, the expiry style is different. It's called a European option. Now, European options are a bit more rigid in the sense that you can only exercise on the expiry date. You can't exercise before, which is unlike the American options. So it gives you a bit of inflexibility in that sense. So if you are someone that's want to have a longer term of the market, you have a view of the market for probably more longer than a month or so, the quarterly options are more preferred options to trade based on the listing cycle. European options for the weekly and end of month options are more short dated options. So when you trade short dated options, the main key thing is that you have shorter time of expiry. So the option value can get very volatile as we get closer to expiry. I'll explain more in detail later. So I think it's important if you have a view of the market. I think the second thing is that what kind of time frame are you looking at? Are you looking at a shorter term or longer term? Now, longer term is always preferred, but keep in mind, because there's a time value factor in it, those options are usually cost more. So long dated options usually cost slightly more premium because of the time factor. So do keep that in mind. I think the type exercises for options is important to take note, whether you are trading on American options or European style option. Now, there's also other settings when you're trading options. There's specifications that you need to know, which is usually at this point of time, a lot of people get a bit confused because unlike many other instruments, options tend to be more complex in the sense there's a lot of terminologies that we need to know. First thing, we need to understand what is strike price. So strike price is a price which the underlying asset may be bought by the holder of the call or sold by the holder of put. So for example, if you are buying a micro E-mini Nasdaq strike price of 14,000, so that means 14,000 is basically your strike value. If the market value goes above, that means pretty much this call value is out of the money. If the market price falls below the strike price, that means pretty much the call option is pretty much in the money. So these are the things that we need to take note. Which kind of strike price are you looking at? So there's a lot of series of option codes that's listed, and you just need to choose which particular strike price that you're looking at. Now, the second key thing is always expiration date. As I mentioned earlier, there's two style of option expiry, and the dates of it when it expires is important. So if you are trading on the quarterly options, usually it's expired on the third Friday of a particular month, option month. So, for example, if you are trading on June right now, it will be expired on the third Friday of the June contract. So that's how we need to distinguish when the option expires. And it's important because if you are, like I mentioned, if you are doing short dated options, it gets very crucial. If during the weekly options, a lot of traders will sometimes, that's why I think it's easier in the sense that because European style, even if you forgot to close the contract, you will just exercise accordingly. But again, short dated options, because of the time value that's quite short, so these options tend to be more volatile. So that's where we really need to distinguish as to what kind of time duration are you looking at. So expiration date is one important element when you need to know if you are trading on the options market. Settlement procedures are usually very easy. You are trading a indices product, so usually it's cash settle. Now, if you are trading non-index or commodities market, therefore it gets a bit complicated because ultimately options, the underlying instrument is a futures contract, and if the futures contract entitles you to settle physically, that's where it gets a bit more complicated. So if you are a trader, you also need to look at what are settlement options that's available on the market. So just to share with you, this is a series of the option codes that's available. This is on micro, E-mini, Nasdaq option. So you can clearly see that these are how it's being listed on the platform. This is taken on Phillip Noah. So you can clearly see that we have distinguished by the strike prices that's available. So if the market on Nasdaq is doing about 13,000, so you should be looking at strike prices that's not too far away. If you are if market is doing at 13,000, you're looking at strike price like probably 3,000. That doesn't make any sense because it's too far for the market to be reaching at those levels. It's not impossible. There's still a likelihood, but the chances of it is actually very low. So always when we look at options quotes or option chains, we try to look at strike prices as close as to where the market is, or rather if you look at it in moneyness term, is what we call in the money options or at the money options. Now we also look at out of the money options, which means strike prices that's far above the market value but not too far away, because as the market if you look at strike prices that's too far away, sometimes there's not much volume traded, and also there's not much quote that's being quoted. So that's where we really need to be careful if you're looking at option quotes. So try to pick those strike prices as quite close to where the market value is at that point in time. So just to show you on how the option code is being listed and how it's what's the certain key terminologies that we need to take note of. So first thing is always a contract code. So if you see an MNQ code, usually means it's a quarterly options. So it's always listed on a quarterly basis. Now, the reason I always emphasize quarterly options because the time duration, you have a longer time episode. So in a sense that you don't have to worry about weekly fluctuations or monthly fluctuations. But keep in mind, because of its longer dated, you have time value factor in there. So generally, this kind of option price will slightly be more higher because of time factor involved. Then obviously you have a contract name. So if you are not familiar with a contract code, you can always refer the contract name in full. So it's a CME Micro E-mini Nasdaq June 2023 contract. So C means it's a call option. If you see a P means it's a put options. And if you see the 13,600 is basically the strike price of a particular option. So this particular option has a strike price of 13,600. Now we have a bid volume, we have the bid and ask column, and also we have the ask volume. And standard market measurements, like we have the high of the day, the low of the day, and also the last traded price. So these are basically how we look at it and how we gauge a particular option value for a particular strike price. So now calculating the intrinsic value of an option is important because we need to understand how the option price being derived. It's just basically the value of option is consisted of two major ingredients. I think the first thing is the intrinsic value, and the second thing is actually the time value. So if you just look at it, the MNQ, pretty much the market of micro-mini assets trading at 14,508, and the call option for this particular strike price of 13,600 is doing at 941 ticks. So the way to calculate is simple. So if you look at it, the call strike price is 13,600 and the market price is 14,508. If you just minus it off, you get an intrinsic value of 908. Now, if you consider 908 and 941, there's a difference of 33 ticks here. So what this 33 ticks tells you is that we are about 2 or 3 weeks away from the third Friday of June, which is the expiry date of this quarterly contract. So there's still a bit of time value factor. Now, as you get closer to the expiry date, you notice that the time value will decline gradually. So there will be more component of the intrinsic value that plays a big role in the value of the option or price into the option. So I think this is another important distinction you need to take note. So as you have a longer dated options, usually the time value will be a bit higher. So in that sense, you actually price the particular call option at a higher price. That's an important distinction we have to take note if you are trading a longer dated options. Now, this is basically a contract specification for micro E-mini and the micro E-mini Nasdaq and S&P 500 for options contract. Keep in mind the listing cycle is very important. Whether you are trading quarterly, the monthly options or the weekly options, most of these options, they have a different style of expiring. The quarterly options are mainly, American style. The monthly and the weekly options are European style. So that's an important distinction in take note. And the contract code for it is also different. So what I shown earlier in the example is actually a quarterly options, which is symbolized by M and Q. If you are doing the monthly options, you'll be MQE. So these are some of the distinctions you need to take note. And do take the time to go through the contract specification because it entails you, how the option code is being quoted on the system. Now, the listing cycle is one thing that gets everyone, if you are new to the market, it gets a bit tedious in the sense that, we have a lot of series that's listed. We have the weekly, we have the monthly, and we have the quarterly. Now, to keep things simple, if you want to have a longer term horizon, you don't mind to look at you don't mind to pay a bit of premium because of time value factor. Quarterly options are worth to look at. Now, if you're trading on short dated options, the weekly options are also available for you to look at as well. But the key thing to take note is that shorter dated options gets very volatile when it gets closer to the expiry because there's fluctuation in the underlying, so therefore influence the price of the options market. So that's the important distinction we need to take note. And keep in mind, these are European style. You can't make a decision whereby next Friday will be the expiry of the weekly Friday options. Next Tuesday or Monday you want to exercise the options contract. You can't because it's a European style. You only can exercise on the day itself. So I think that's where we really need to get around by the listing calendars, which particular options is more suitable for your style of trading. So just to re-emphasize, we have the weekly, the end of month, and the quarterly options as listed. Keep in mind, the weekly and end of month options are always European style options. That means they only can exercise on the expiry day, while the quarterly options, they are highly flexible. They are American style. So any time of the day before the expiry, you can always exercise the option. So now, again, just another example on how to calculate the option value. So keep in mind, if let's say the market code is 13,640, so if you are looking at about a call strike price of 13,400, so you can do your maths there. If the option price is 414, so intrinsic value itself is close to about 240 index points. So again, this time value is about 174. Keep in mind because there's a lot of time duration involved, and this option is going to expire in 9 months. So when you have a longer dated options, the premium that you pay for time value is actually a lot. Because keep in mind, when you have time in your sight, there's higher chance for particular options to expire in the money. So therefore, the time value factor is always a significant factor if the time or the duration of the expiry is longer. So keep that in mind. So a lot of people would tend to gravitate, if they don't want to pay so much on time value, they want to do shorter dated options. But there's also pros and cons of doing short dated options, because if the time to expiry is shorter, it actually influence you if the market behaves very violently. So if the market moves very volatile in the short period of time, normally it moves the option value in a quite drastic way as well. So that's something that we have to play a balance, and we have to approach it differently. So relationship between strike price and obviously the underlying price, which is the market price. The lower the exercise price or the strike price, the higher you have to pay for your premium for the call. If you reverse the scenario, if your highest strike price normally for the put market, there will be a lower premium. Now, if you change that around, the higher the exercise price, the premium for the call usually is lower, but you pay a higher premium for the put market. So that's the relationship between the strike price and the underlying price. Now, investor will be willing to pay more premium if the call option strike price is below the underlying. Normally, if it's out of the money options, very simple. If you're a buyer of the call, you tend not to exercise. You just let the option expire worthless, and what the buyer will suffer is basically the premium that they pay. Now, if the market price fall below the strike price, that's where it gets interesting. In most cases, because the options has turned from out the money becomes at the money or in the money type options, that's where a lot of buyer of the options will start to exercise the contract. So if the call strike price is higher than the current underlying, you'll be willing to pay less premium. Because obviously you can always buy from the market which is cheaper. So that's how the relationship between the strike price and the market price works. It's a reverse scenario for a put market, because put market is basically you're hoping that the market to go down. So obviously with the lower the premium, the lower the strike price is, the lower premium of the put market. Now, just to put it into a graphical, just to put a graphical picture, if you just look at the picture on the left, you can clearly see the moneyness of an option is defined as, option premium has two parts. One is intrinsic value and one is time value. We have shown to you the calculation earlier. So if you just look at how the options moneyness is being derived, so as long as the market price is below the strike price for call options, is pretty much an in the money call. And usually this type of call, the premium you pay for this type of call is usually very high. First thing, there's intrinsic value and there's also a time value. Now, if for a buyer of a call, and if the market price is higher than the strike price of a call market, normally what we call is out of money cost. In this example, there's no intrinsic value, because normally in normal circumstances, no people want to exercise when market price is much higher than the strike price. So in that sense, the only value for this out of money cost is pretty much a time value factor. So a lot of people would like to buy out of money options, because given the fact that there's no intrinsic value, and they're playing on the probability that this out of money cost will eventually be at the money or in the money when the market is in their favor. It's crucial to take note, if you have this kind of view, if you are banking on out of money cost, the time value element is important. As I said, time value is always higher, especially if you have longer term of expiry. If you have shorter term of expiry, normally the time value is quite insignificant. So that's where the distinguish we have to take note of. So for the put scenario is at the reverse. So anything that's anything that's below the strike price, normally you won't exercise, and anything that's above that, usually you exercise. So that's how we define the value of an option. Now, besides having the relationship between strike price and options, between the relationship between strike price and the market price, there's also other factors that's actually affecting the option premium. First thing is always the time value, and keep in mind, time value always decay. If you just look at the chart before, the time value for option is always, it starts at a very high value and eventually it will decay right until the day of expiry. So on the day of expiry, theoretical value of a time value is actually 0. So time decay is actually an important element. Now, the fourth element is actually very important, which much talk about if you're trading options, actually implied volatility. Implied volatility basically, how the market actually implied a particular volatility to a particular option contract, which I will discuss a bit more later. So this is basically to show you an example of how option is being quoted. So clearly you can see right now the current price of the market is 13,645. So we try to pick an option strike price that's quite close to where the market is trading. So if you notice, those call option strike prices quite close to the market price usually have high premium value. As we get further away from the market, you notice that the premium you pay is getting lesser and lesser. Keep in mind, if you just look at it, any out of the money options in call above anything above 13,645 is technically an out of the money options. You won't exercise it, and you see the premium that you pay is actually getting lesser and lesser. Now, keep in mind, a lot of people tend to gravitate to this type of out of money options. But then again, eventually, if the market doesn't go in that favor, most of the time the options of this will expire worthless. So that's where you really need to take note of as well. So another way to trade call options in a very simple fashion is that if you have a view of the market, that generally the micro E-mini Nasdaq is going to go higher. Generally, what we do is that you can just buy a call at a particular strike price. So in this case, it's looking at a call at 13,800, and just look at it. Just within a couple of days, the call strike, the call value actually increases about 100 ticks. That's also pretty much in line how the market movement as well. So keep in mind this is one simple way of trading option by having a view of the market. So if you have a view of the underlying that's going to go higher, I think call option is a very good strategy that you can use for you to engage in that view. So in this sense, you can clearly see the same strike price in a matter of days actually increased by a substantial amount, obviously with the increase in the underlying. Now, going to the next step, trading options, we also need to understand the Greeks. Now, I'm not going to go too deep on this because when you go into Greek matters, trading options, it gets very complicated. But there's one important element that we need to take note when we talk about option Greeks is basically the delta. Now, delta measures the change in option price with one change in the underlying price. So obviously, a higher delta means the option price will be more sensitive. Now, gamma and the rest is gamma is basically talking about second derivative. You understand calculus, it's just basically a second derivative measurement of delta. Vega is talking about volatility on how per unit change in option price against the volatility. Theta is more to the time factor, and rho is actually more of the interest rate element. Now, delta is a key thing in terms of the option Greeks because when you look at the delta of a particular options, you need to understand that if you have a high delta, that means it's very sensitive to the movement in the underlying. Now, if you just look at it in a call option example, call options that usually in the money, especially those that deep in the money, has very high delta. And delta value for call is usually from 0 to 1. Now, vice versa, if you have a delta of a put option, decrease. That's deep in the money, the delta value will also be very low in a sense that it's very close to -1 because it's a put contract. So whenever there's a underlying decrease, the put options value will increase. So that's how we distinguish. So it's important for us whenever we use delta as a measurement, we need to understand in a sense that whenever you look at call options, especially those that's deep in the money, actually the delta of the call options is actually particularly very high. In that sense, it's actually very sensitive to the underlying movement. So that's an important distinction that you have to take note. So just to go a little bit on delta, I think the concept of delta is in a sense that if you are trading options, it actually measures the sensitivity of options to its underlying, and it's basically how it helps the trader understand how a particular option move whenever the underlying instrument move. So if you have high delta, that means whenever the underlying move by one unit or 1%, it shows you how much of an option price movement. So obviously you want If you don't want to be too sensitive on a delta, you should be choosing less delta value. But if you want something that's a bit more aggressive, therefore you choose a bit higher delta. That's why those deep in the money call options usually at high delta is because the intrinsic value itself is very high, and therefore whenever the underlying move shifts in favor of the options, that will create a higher value, a higher intrinsic value. So therefore, delta in certain ways also reflect the changes as well. So put options is the way around. I think it's important for us to understand delta. And I think if you just look at out of money options, usually they have pretty much a very low delta. And I think that's where it entices a lot of traders to go into most of the out of money options, because in a way it seems cheaper and it's actually less sensitive. But keep in mind, because of time factor involved, as those out of money options starts to go into at the money or in the money options, the delta value also will change. So that's where we need to be aware of as well. Now, another part of grid is looking at gamma. Now, I'm not going to touch too much on gamma. Basically, it's just a second derivative of delta. As long as you have high delta, normally you have a high gamma. And keep in mind, I think a lot of traders will look at Greeks, especially delta, to see how sensitive the option price is. If they want more sensitivity, they look at higher delta options across the option value chain. So that's something that traders would like to pay attention to. And I think because of out the money options are less sensitive, a lot of people tend to gravitate to that. But again, there's always a chance that out of money options will stay at out of money throughout the whole period of the length of the options listed duration. So that's the risk. So again, there's always a balance we have to play off, and that's where we need to be well comfortable with. Now, implied volatility is another concept that's very instrumental to options trading. And it gets very complicated in the sense that if you try to understand in depth what implied volatility is, you tend to get confused at the end of the day. I think in other words, just to put in plain words, I think what implied volatility stands for, especially when trading options, is how expensive or cheap of an option market is. Low implied volatility usually reflects that the market is not expecting that a particular option will move so volatile. If we see a high implied volatility of a particular option, that means that particular option or particular option series will usually encounter a high implied volatility period. That means a particular instrument will likely move in a very volatile fashion in the next coming days or weeks or months. So a lot of traders, first they look at delta. I think the second key instrument that they look at is actually look at implied volatility. So if they look at, they will rather want high IV options, because these options will usually encounter more volatile periods or more volatile price. In that sense, they'll probably able to pocket more profit in that sense. If you just look at low implied, that means in other words, there is low volatility in a particular instrument, particular options contract. So therefore, there's unlikely of a big move in the market. So in other words, it's actually cheap, because usually this type of options they price cheaper because there's not much movement they predict there's not much movement in the market. So therefore, they usually price the option value cheaper. Now, many people tend to gravitate towards high IV because of the possible volatility of big movement in the market. Now that's a price you pay, because usually we have a high IV, that means the option will not be cheap. And if you just look at low IV, normally those options are usually priced very I would say quite attractive in a sense. But then again, those people who purchase low IV options contracts, whenever they face shorter time duration, the market may not have enough time to actually move in their favor. So therefore, again, I think they run a risk of the option being expired worthless. So that's how we gauge whether higher implied volatility or lower implied volatility is useful for a particular trader. And it all boils down to your objective at the end of the day. So are you looking at something that is lower risk, So therefore, you gravitate to lower IV given the time that you have. So that's where you need to balance as well. Now, these are some of the common option strategy. I'm not going to go too deep on some of the complex synthetic strategies like iron condor or straddle or strangle. What I want to focus more is basically the direct approach. Basically, you're having a long call, long put, and a short call and short put options. Now, long call is simple. I think whenever a buyer of a call option, it has always a view that the market is going to go up. And just to protect you on the downside in case the market falls, call option is always favored. Now, if you're doing a futures contract, if you just buy a futures contract, whenever the market go against you, you are subject to losses. And those losses are theoretically unlimited, unless you cut it, you have a forced stop loss strategy or whatnot. Having a call option, on the other hand, keeps you always on the ball, because you're always subject to the limited premium that you pay for a particular call option. So given the view that the market, you have a view the market is going to go up, having a call option gives you, the kind of flexibility in the sense that, you always be comfortable in the sense that you're only losing the premium that you pay for a particular call option. So in this example, if you are looking at the market is going to go higher on the micro NASDAQ, with a strike price of 14,900, you're paying about a premium of about 77 ticks. So, obviously your break-even point is including the premium that you pay. So as long as the market goes above 14,000 or close to 15,000 points, you'll be making money on this option. You'll be, or other words, the call option is actually in the money. Anything that's below 14,900 technically is out of money options. You won't exercise it and you will lose the 77 ticks. So it's a fair enough game if you're having a view of the market. Now, put option on the other hand is the other way around. If you're thinking the market is going to come down, and it's pretty much buying a view of the overview of a bearish market. So in that sense, you can buy a put with a strike price of 14,000, and you'll be paying 123 ticks premium. So as long as the market doesn't fall, you'll be losing the 123 ticks only. But if the market does fall, you'll be enjoying the profit potential of a put option contract. Now, shorting call and shorting put is an essential strategy, especially if you are looking at a counter view of the market. So if you just look at short call, for example, you buy a call in hoping that your view of the market is going to go higher. Shorting a call is the other way around. You're hoping that the market is going to come down. So it's usually considered a bearish option strategy. Now, I tend not to, short call or short put because the profit potential is quite limited, but the risk potential is pretty much unlimited. Keep in mind, because shorting a call, shorting a put, you have an obligation. So whenever the buyer of your call or your put exercise his rights, you have to pretty much deliver on that obligation and subject yourself to unlimited loss. Now, this is basically in reference to naked shorting call or shorting put. Obviously, in market nowadays, there's always a favorite strategy by having yourself covered, in a sense that if you are shorting a call, you probably will be at the same time buying an underlying. In that sense, you are hedged, and that's what we call covered call position. To do a naked short call or short put is actually very dangerous because you're actually subjecting yourself to unlimited losses, but your potential of profit is actually very limited by the premium that you actually receive from the buyer. So in that sense, you really have to be careful. If you really want to do the short side, you are actually exposing yourself to a lot of risk. Despite even you cover yourself or hedging yourself with a buying position on underlying, sometimes because of the strike price it runs or market price it runs, you may not hedge it. You may not hedge it in a very perfect manner, and therefore you tend to get a bit downside compared to if you are shorting a call. You have a view of the market that's going to be bearish. Instead of doing a short call, you can always buy a put. So that's where shorting tends to a bit more, I would say, it's a bit more downside than comparing to be on the buyer side. So that's where we really need to be careful. But again, I think a lot of people they prefer to sell because you get a premium upfront, and therefore with the premium that you get, if the market doesn't move much, you'll be enjoying the premium that you get from the buyer. So that's where there's a lot of a trader who like that kind of position, because if the market is not going anywhere, selling options is quite a beneficial way for you to earn or to generate income, in other words. So selling options is basically, you can always sell call, or sell put, and it all depends on what kind of view of the market that you're having. But keep in mind, if you're doing a naked short, you're always exposing yourself to too much of a risk. So pay off a short call. So if you are selling options, you're receiving premium. So if let's say you're selling a call at 14,800, the premium that you get is 93 ticks. So as long as market stays around that range, you probably will get your premium. But imagine if the market starts to hit the other way, your loss potential is going to be very great. So that's why you really need to be careful whenever you are doing a naked short. So now trading options, you base a lot of your decision based on market view. There's a lot of ways for you to derive market view. One of it is looking at the charts technically, and from there you form your basis. So if you just look at this classic example on micro E-mini Nasdaq futures, you can clearly see the 14,000 to be a very strong resistance. So if it does cross that, probably you believe the rally is going to start coming in and it can sustain. So in other words, you probably can look at options, probably with a strike price about 14,000 and above, and you're hoping that in the next 2 or 3 weeks the market close above 14,000. The premium or the call that you purchase will probably go up in value, and that's where you can earn a profit. So just as a classic example, so based on the example I shown to you earlier, the 14,000 seems to be reachable, and you just buy a call option that's probably in the money, slightly in the money or at the money, and if just look at you hold it for the next couple of days and the market does break 14,000, there's a rally, you see how the options value, your call options actually increase in value. So this is talking about 300 ticks in a matter of days. So that's how leverage it is, and how so importantly is to look at delta, and importantly also to look at IV of particular option. So you just see how how quickly or how fast it is for option value to increase in price, especially when the movement underlying is actually very great. So just to share with you a classic example on how I look at making decisions whether to buy a call or buy a put in our options market, is to look at how the underlying of a particular instrument behaves. So this is why we have a micro E-mini Nasdaq chart, and I always like Heiken Ashi candles because it's slightly different from Japanese candlesticks, because Japanese candlesticks, it gets very complicated. There's a lot of decision to make. If just use Heiken Ashi candles, are very clear and simple. If the trend is up, just look into call options. If the trend is down, look into the put options. And look at the delta, look at IV which is being quoted. Now, if you just look at it, Nasdaq, the micro mini Nasdaq futures contract does have a lot of leg on the upside. So call options actually bring favor at the moment. So if you just look at overall trend, of the micro mini Nasdaq, you can clearly see that the market is actually crossing above, bullish territory. If you just look at the moving averages, it's actually also, the candles are trading above its 50 and 200 period EMAs, which is a good sign. That means there's continuing momentum on the bullishness. If you just look at ADX value, which is another indicator to indicate strength in the market, and it's doing above 20, that means strength is in place, and the trend is going to gain momentum. So keep in mind, I think these are good setups for you to look at call options on the micro E-mini Nasdaq. Now, if you look at micro E-mini S&P, it's slightly different. If you just look at where the market is heading for S&P 500, you can clearly see the market is going sideways. It's heading to pretty much there's no upside or downside. It's heading on a quite rangy market. Now, in this scenario, if you're doing straddle or strangle, hoping that the market will be in a tight range, is a very good strategy if you're using a complicated strategy like strangle or straddle. Now, if you are just buying call and buying put, if the market doesn't trend, that's where you tend to get a bit more downside, because sometimes the options can expire worthless. So that's where we really need to take note of. So right now, MES, it doesn't look at doesn't pretty much show much of a breakout movement. It's pretty much on a sideways market. So option strategy, we really need to look at certain type of style that fits a ranging market, especially those straggle and strangle type of strategies. Now, just to show you why I use Heiken Ashi as a way to gauge where the market direction is. If you just look at two charts here, they are all same time frame, same product, and you just look at it with your naked eye, which is a better chart to look at. If you are a trend trader, obviously the chart on the right would be a better choice. Now, the chart on the left is basically using normal Japanese candlesticks. The chart on the right is basically using Heiken Ashi. You can clearly see if you're using Heiken Ashi, you are staying on a trend longer. Keep in mind, these are all hourly charts. So, when very simple, if you're using Heiken Ashi, there's only three simple patterns that you need to take note. As long as it's a blue bar, it's a green bar, it's showing you an uptrend. It's a red bar, it's showing you a downtrend. And as long as the candles, you don't have much of a, whether it's upper wick or down wicks, that shows you the momentum is strong. If you have a candle that is showing you upper and lower wicks, that tells you generally the momentum or probably the particular trend is losing strength. Reversal is very simple. If the market is going sideways, normally you see the candlestick patterns are usually green and red series together, and those body of the candles are usually very short. So in those examples, normally the market is actually heading to a sideways market. So Heiken actually it makes you distinguish the trend in a clearer fashion, and in other words, you can stay on the trend longer, and you're able to identify whether the trend on market is bullish or bearish at that point in time. Now, obviously, if you just look at comparing Heiken Ashi Japanese candlesticks, if you're using normal Japanese candlesticks, the complicated part is interpreting it. There's over 100 or more than 100 over different combinations, and it's very subjective in nature. Some people may say this is a different type of configuration. Some may say it's another type of configuration. If Heiken Ashi is simple, there's only three distinct types, and that's all you need to know. The only drawback about using Heiken Ashi as compared to Japanese candlestick is if you're looking at gaps, a particular chart, Japanese candlestick shows you the gap. Heiken Ashi doesn't. So in that sense, if you're a gap trader, no, you can't use Heiken Ashi. You have to use the normal Japanese candlesticks. And it's because if you just look at how Heiken Ashi is being derived, it's actually using the middle bar of every Japanese candlesticks. So in that sense, you can quantify it. You can actually make it as a algo strategy. As compared to Japanese candlesticks, you can't, because it involves a lot of interpretation, which is you need a human eye to interpret it. So a classic example of using Heiken Ashi together combining with moving averages is whenever you see a green Heiken Ashi bars, and those bars are trading above the moving averages, those are very good setup for bullish, bullish market. So in those cases or those instances, you can actually look at the options market to see where the call options are valued at that time. Now, just to add another strategy, if you are doing a trend trading, which is very common if you are doing options, buying call and buying put usually refers to trend of the market. Now, one way to look at it is to look at ADX value. As long as ADX value is above 20, that shows you the strength in the market. So right now, you just look at where micro, mini, Nasdaq is. There's still strength in the momentum in the uptrend that we're seeing right now. So as long as ADX value is high, that shows you the strength of the trend is still there. But once the ADX value starts to decline, that tells you the strength or the momentum or the upside will start to decrease, and that's where you need to be careful. If you're holding a call options at that time, probably there's a time for you to get out or to take a profit potential on your options. So why trade options on micro, mini futures? I think it's simple. I think because of the leverage factor. Micros are always 1/10 of the E-mini products. So in a sense, it's a smaller contract. It gives you a lot of flexibility. And in other words, it's also easier for you to adjust accordingly. Now, options is much preferred because of the versatility. There's a lot of strategies that you can use. So despite various market conditions, you can always use different setup, different strategy that you can look at, whether it's condor, whether it's strangle, straddle, those complex strategies to form a particular view of the market. So like I mentioned earlier, if the market is heading sideways, like what you see in the S&P 500, you can obviously use a bit more complicated strategies. rather than just buying call and buying put. Now, options are also very liquid, especially on a CME exchange, and you don't have an issue of getting in and out, and you can offset with the futures contract or the e-mini contracts, so it gives you a bit more flexibility especially on the margins. Now, a lot of people compare options contracts with a lot of other asset classes when it comes to liquidity. I think I showed to you the next slide. I think trading on the options market right now is getting more participation, and therefore I think you look at some of the option prices, especially those out of money options, some of them are being quoted quite volatile prices. So I think that shows you there's a lot of participation in the market, and as long as underlying gets volatile, there's always be interest in the options market as well. So same goes with underlying. The futures contract is traded almost 23 hours. Same goes for the option contracts as well. So just look at the micro e-mini options that's being introduced, I think close to more than 2 years now. You can see the average daily volume has actually been increasing over the years. So that shows you the interest in the options market is actually there. So it gives you, in other words, it gives a trader a bit more options when it comes to designing the strategy that can fit their particular time frame or particular style or particular market scenario. So options in a way is highly flexible, and it gives you the kind of comfort in the sense that you don't have to worry if you're buying call, you don't have to worry about the downside because it's well protected, or you're buying put, you don't have to worry about the upside, it's also well protected. So in that sense, it gives a bit of comfort when it comes to market conditions when it gets more volatile. So with that, I'm just going to end here and just going to open the floor for any question and answers. So over to you, Sri.
Hello, David. Thank you for your valuable insights. I hope the audience found it equally useful as well, and we'll go on to add options to their strategies. It's a great opportunity to ask questions that you may have about options trading. I mean, this is something that we do hear from our customers, and if you have questions or you want to take this opportunity to clarify some doubts about options trading before you see how you can use it for your trading, this will be a great time to do so. We have proprietary trader David Ng to give us some insights. We have some questions at the moment. For those of you who have questions that you would like answered, you can go to the question panel located somewhere near the bottom of your control panel. Just click on that and type your questions in there, and we'll try to address it during this session. Okay, first up, we have a question from Yuan Tang. Yuan Tang is asking, is a short put equals sell a put option?
Okay, I think the context had to be set here. I think when you say shorting an option, basically you have a naked position.
So you want to show your slides, David, if that's easier?
Yeah. So if we just to set a context here, right? Selling options basically, if you have a naked position, and you are just selling a particular option into the market, whether it's call or put. In that sense, you are selling a particular option of the market. So that, I hope that answers the question. It's not basically looking at I would say like buying a call, then you sell a call at a different strike price. That's a combination of strategy. But here, what I'm referring to selling options, basically having a naked position and selling a particular call or selling a particular put at a particular strike price.
Right. The next question is okay. Next one is from Henry. He's asking if he can replay this webinar session after it ends. Yes, we'll share a link to the webinar in our follow-up email. You can also view the video on Phillip Nova Facebook or Phillip Nova YouTube channel. The video will be there. If you have any other questions, please take this opportunity to ask David. David, maybe one question from you right now. What would be the top 3 takeaways for today's session? What are the top 3 things you want the audience to remember and take note of?
Okay. Yeah, sure. I think the first thing is that use options as a way to as part of your trading arsenal. So in a sense that if you have a view of the market, just use option as a way for you to add to your basket of trading tools. So if you are already trading futures market, look at options market as a way to enhance your return. Keep in mind, although option has a lot of complication when it comes to terminology, but if you get past that, it actually enhances your return in quite a substantial manner. The only thing is that, like I mentioned earlier on in the slide, is that we really have to be educated in a way to use options because of complexity of the different the factors that influence option pricing. It may get quite complicated to a certain extent. But if you keep it simple, if you like how I mentioned earlier, a very simple direct strategy or direct approach is, if you have a view of the market is going to go higher, look at call options. If you have a view of the market is going to go lower, look at the put options. I wouldn't recommend on going shorting a particular options because the risk that's being involved. But again, if you have a well understanding of doing and selling options, go for it. But I always have a view that use options as a way for you to enhance your particular strategy of the market. So that's pretty much my main takeaway.
All right. Any other questions before we close the session for today? If you have additional questions after the webinar, you can also type it in our post webinar feedback form, and we will send these questions to David to address them, so we can add them to our follow-up email. Okay, the questions are coming in fast and furious. We have Dave who's asking, an out of money option is cheaper. Is this correct, David?
Now, theoretically, our money options usually we don't have intrinsic value, so therefore you only have a time value element. So therefore, technically, it looks cheaper. Now, obviously, there's also instances whereby, again, because all these options are out of money options are also traded in a market. So if a trader will have a view, say, oh, a particular market is going to go at certain value at this period of time, they may push this out of money options higher. So therefore, it may not look cheap. So again, I think our context that we need to understand is that even though out of money options may look cheap because there's not much of intrinsic value, but these options are also traded on the market. So if a particular trader were to say that, I have a firm belief that the markets go to this level, and he's going to buy up all out the money options, so it may push out the money options value higher because of the market element. So therefore, I think we really need to be aware of this such element. But generally, I think in normal circumstances, generally out the money options are usually cheaper because there's a lack of intrinsic value.
All right, the next question is Isuran is asking, can we buy options for CME soybean oil? Is that do they have options for that contract?
I think this one probably you can speak to any Phillip Nova representative. They probably be better position to advise you whether they have whether do they offer CME soybean options on the platform.
All right, Isran, we'll do a check and we'll take this offline with you. Meanwhile, we have one more question from Henry. Henry is asking, if the option expired and is in the money, do we have a choice of not exercising the option and just collect the difference?
Now, usually in the money options, people, because of this is cash settle contract, normally if you just hold in the money options till the expiry, you just settle the profit differential and credit into your account. Now, again, it goes back to whether it's American options or European options. So if it's a European options, you can't exercise beforehand. You only can exercise on the day itself. American, you can do that. But then again, I think that they may subject to certain costs. Again, I think this you can speak to Phillip Nova representative. They'll probably be better to advise you on this.
All right, I believe that's all the time that we have for today. If you have more questions, you can send them in our survey form at the end of the webinar, and we'll get them to David to give us his quick replies, and we'll add them to our follow-up email so you will be able to view the video of this webinar as well as have your questions post-webinar addressed by David himself. All right, thank you so much for joining us for this live webinar. Till our next webinar, please take care and all the very best in your trading for the rest of the week. Thank you so much as well, David.
Always a pleasure.
All right, great. Have a good night. Take care.